Ever wondered how a major real estate player navigates today's complex market? We are diving deep into Keppel REIT, a Singapore-based powerhouse in premium office properties across Asia-Pacific. They've shown resilience, but are they poised for growth, or are there hidden risks? In this video, we'll break down Keppel REIT's recent performance, their strategic moves, and what analysts are saying, all based on the latest available data for fiscal year 2024 and the first quarter of 2025. By the end, you'll have a clearer picture of whether this REIT fits your investment strategy. If you haven't already subscribed to our channel, please subscribe to our channel. Your support truly makes a difference, enabling us to produce more stock and fundamental analysis content. But first, a quick disclaimer. Please note that the content presented in this video is for informational purposes only and does not constitute investment advice. We strongly recommend that you seek proper guidance from a qualified financial advisor before making any investment decisions. At its core, Keppel REIT is a Singaporean real estate investment trust focused on owning and managing premium-grade commercial properties. Their main goal? To generate a stable income stream and grow capital for their investors over the long term. They're sponsored by Keppel Land Limited, a major property firm, and managed by a subsidiary of Keppel Capital Holdings. Think of them as a landlord for some of the most desirable office spaces in cities like Singapore, Sydney, and Seoul. They also emphasize transparency, proactively sharing information to build trust with investors, which is crucial, especially during market fluctuations. Let's talk numbers. Keppel REIT shows a mixed financial picture. Good news: property income and net property income have been robustly growing. Property income for FY 2024 jumped 12.2% year-on-year to 261.6 million Singapore dollars. With NPI increasing by 10.7% to 201.9 million Singapore dollars. This strong trend continued into 1Q 2025. This growth is largely thanks to their strong operational performance and recent strategic acquisitions like 255 George Street in Sydney. The challenge: distributable income and DPU. Despite the top-line growth, your actual payouts have been under pressure. DPU declined 3.4% in FY 2024 to 5.60 cents. This continued in 1Q 2025, primarily due to a significant surge in borrowing costs, up 32.2% in FY 2024 and another 23.4% in 1Q 2025. Essentially, their properties are earning more, but the cost of borrowing money to run those properties is eating into the profits that can be distributed to unit holders. Plus, starting FY 2025, the manager is taking 25% of their fees in cash, further impacting distributable income. So, how healthy is their balance sheet? Aggregate leverage: it's sound, standing at 41.2% at end FY 2024 and 42.1% in 1Q 2025. This is well within Singapore's regulatory limit of 50%. Interest rates and hedging: their all-in interest rate rose slightly to 3.52% in 1Q 2025. A smart move. A significant portion, 65 to 69%, of their borrowings are on fixed rates, which help shield them from rate hikes. Sustainability-linked financing. This is a major positive. 82% of their total borrowings are now sustainability-linked, exceeding their own 2025 target. They even have a very good rating from Moody's for their green financing framework. This could mean more favorable borrowing terms and appeals to environmentally conscious investors. Despite market shifts, Keppel REIT's properties are performing well operationally. Occupancy rates: they maintain a high portfolio committed occupancy at 96% in 1Q 2025. There was a slight dip from 97.9% in FY 2024 due to some non-renewals at Ocean Financial Centre and Keppel Bay Tower in Singapore and T Tower in Seoul. But here's the good news: 70% of the vacated space at Ocean Financial Centre has already been successfully re-leased. Rental reversion: this is key. Keppel REIT has consistently achieved strong rental increases when leases renew, reporting 13.2% in FY 2024 and a robust 10.6% in 1Q 2025. This shows strong demand for their premium office spaces. Lease expiry: The weighted average lease expiry is 4.7 years for the overall portfolio, meaning a stable income base. For their top 10 tenants, it's even longer, around 8.7 to 9.0 years. However, Singapore properties have a shorter WALE of 2.6 years, meaning more frequent renewals in their largest market. Keppel REIT's portfolio is valued at 9.5 billion Singapore dollars and is strategically composed of premium-grade office spaces primarily in prime central business districts. Heavy Singapore concentration. A whopping 88.6% of their income comes from Singapore. This is great when the Singapore market is strong, driven by the flight to quality trend. International footprint. They also have strategic presence in Australia, 10.9%, South Korea, 0.5%, and a tiny bit in Japan. Key properties include iconic Singaporean assets like Ocean Financial Centre and Marina Bay Financial Centre, and in Australia, 255 George Street. The different WALE for Singapore, 2.6 years, versus Australia, 10.2 years, allows them to capitalise on dynamic shorter-term renewals in Singapore while benefiting from long-term stability in Australia. What's fueling Keppel REIT's future? Strategic acquisitions. Buying assets like 255 George Street has already boosted their income. They're looking to expand into other target markets like Japan, South Korea, and Europe. Flight to quality trend. Tenants are increasingly demanding premium, high-quality office spaces, especially those with strong sustainability credentials. Keppel REIT's portfolio is perfectly positioned for this, evidenced by their strong rental reversions. Sustainability initiatives. Their 82% sustainability-linked borrowings and green-certified properties. All Singapore properties are Green Mark Platinum or Super Low Energy certified, make them attractive to ESG-focused investors and tenants, potentially leading to higher occupancy and premium rents. Proactive asset management. Their active leasing, swift releasing of vacated spaces, like 70% at OFC, and asset enhancement initiatives like upgrading One Raffles Quay, all contribute to organic growth and property value. No investment is without risks. For Keppel REIT, key challenges include rising borrowing costs. This is the big one. Higher interest rates mean lower distributable income and DPU, even with strong property performance. A 50 basis point interest rate change could impact DPU by about 1.1%. Singapore concentration. While a strength, 88.6% income from Singapore means they are heavily reliant on that market's economic health. Any downturn or oversupply specifically in Singapore could hit them hard. Lease expiry and occupancy fluctuations. Despite good management, non-renewals and tenant downsizing are always a risk, especially with the shorter WALE for Singapore assets, 2.6 years. Macroeconomic headwinds. Global economic volatility, geopolitical tensions, and cautious business sentiment can affect demand for office space. Valuation concerns. Some analysts note Keppel REIT's price-to-earnings ratio, 34.3x, is significantly higher than its peers, 22.7x, and its estimated fair value. Its dividend yield is also lower than the sector average. Despite the challenges, the consensus among analysts is largely positive, with a buy rating. The average price target is 1.007 Singapore dollars, suggesting potential upside from its current 88 cents price as of June 2025. Analysts like Maybank Research acknowledge the DPU drop due to higher costs, but highlight strong rental reversion and a stabilizing Australian market. DBS Research praises Keppel REIT's best-in-class office portfolio, anticipating strong rental prospects due to the flight to quality trend and limited new supply in Singapore. They also see the move to cash management fees as positive for aligning interests. The general sentiment is that the quality of Keppel REIT's assets and proactive management outweigh the current interest rate pressures. So, what's the bottom line for Keppel REIT? Strong operational core. They're generating robust property income and NPI from high-quality assets and achieving excellent rental reversions. Strategic advantage. Their focus on premium CBD properties and sustainability initiatives positions them well for long-term growth and attracts discerning tenants and investors. Interest rate headwind. The major challenge is rising borrowing costs, which are directly impacting DPU. This is the key metric to watch. Resilient management. They're effectively managing debt and releasing vacated spaces, showing strong asset management capabilities. Analyst confidence. Despite valuation concerns, analysts generally believe in their long-term potential. For investors looking for exposure to high-quality commercial real estate in resilient Asia-Pacific markets, Keppel REIT offers a compelling proposition. However, stay mindful of the ongoing interest rate environment and their ability to continue managing debt costs and occupancy effectively for sustainable long-term returns. What are your thoughts on this? Let us know in the comments below. And if you found this analysis helpful, don't forget to like, share, and subscribe for more in-depth investment insights. Thank you for watching. See you in the next video.